The SmallCapPower expert interview featuring Michael Giordano. Michael Giordano, portfolio manager and vice president of investments at Stone & Company, recently spoke with SmallCapPower regarding his outlook for the resource sector, as well as his capitalization preference when choosing a resource stock to buy. He also offers up some tips as to how he would construct a resource-weighted investment portfolio and reveals some of his top stocks to watch at this time.
Stone Asset Management is a mutual fund company that's been around for 19 years. Basically have multiple funds that we manage. I've been with the company for 10 years and focusing on the resource sector. So I manage both the resource fund and a flow-through fund, as well as helping with the resource components of some of our other funds.
What's your investment track record been like since you joined your firm? Is there one stock in particular you bought that stands out in terms of performance?
Our investment track record has actually been quite good. For example, in 2013, when the gold markets were down 49%, I managed to gain 0.5%, so I was happy for that. And year to date this year, I'm up about 16%, and over 5 years, I'm up about 9.5%. So one of the stocks that I like to hang my coat on is a company called Pason Energy Systems. They're basically an instrumentation company that is the link between the oil and gas drillers and the head office of the company. So they create products that will help the drillers analyze the data that's in the ground. So when I invested in this company approximately 2.5 years ago, it was under $1 billion in market cap. I could still consider that small cap, and it has since tripled in value. So companies like Pason are growing. They're selling their services not only to North America, but they managed to break ground in the Middle East. So I'm looking at companies like that will grow both intrinsically and via acquisitions.
Can you tell us your outlook for the resource sector during the next 1 to 2 years?
The outlook for the resource sector continues to be positive. I think short term there's some challenges both in the energy space and the material space. So energy is oversupplied right now with both oil at record highs in the U.S. as well as nat gas also being very high. That coupled with the milder than normal summer has really cut back on the energy prices. And the base metal prices are challenged with fears of a China slowdown and whatnot. However, mid to long term, I think the outlook is quite positive. China continues to grow. 7.5% returns of GDP is still quite high compared to the high base that they're starting with. So China is growing. The U.S. economy is also growing. So that bodes well for energy demand. The IEA recently came out, and even though they lowered their short-term outlook for oil demand, the oil demand is still growing by 1.5 to 2% per year. So energy continues to be healthy. The nat gas space is also looking good because Mexico is in the process of building pipelines from the U.S. to Mexico in order to consume our nat gas, as well as the LNG terminals which are being built in the Gulf of Mexico as well as the west coast of Canada will bode well for shipping nat gas to Asia, where prices are triple what they are here. On the base metals and precious metal front, continue to be positive. The China growth scenario, where 25 to 30 million people per year are migrating from the country to the city, will require massive infrastructure build, and this bodes well for base metals. Precious metals, we always need an alternative currency, and gold seems to serve that purpose, especially during times of geopolitical uncertainties, which is what we're seeing now. So we want some exposure to gold. So overall, the commodity outlook continues to be positive.
If you were to put together a portfolio of resource stocks today, what would it look like?
Well, I think it's wise to have a diversified portfolio of resource stocks, which means large cap, mid cap, and small cap, as well as some sort of geographic diversification. So in terms of large cap, I like the large cap space because these are companies that have the cash flows and have dividends to support that cash flow. So we want to be able to have the benefits from a company with cash flow, which are able to grow and make acquisitions, for example. The mid cap space is also a lot more growthier than the large cap space, so they have the ability to grow via acquisitions. And then the small cap space are smaller, more nimble companies that have the torque in terms of finding the next new discovery. So I think there's a diversified basket of resource stocks is very important in building a resource portfolio.
Can you tell our viewers which resource stocks you like at this time and why?
So on the energy space, I like two companies. One of them is Whitecap Resources, and this is a Viking/Cardium player in in actually Alberta. And this company has grown both by the drill bit and by acquisitions run by a guy named Grant Fagerheim. So that's WCP on Toronto. I do own the name. So this company, like I said, it has grown. They have some of the best operating metrics, low costs, and continue to grow via acquisition. So Whitecap is one of our mid-cap holdings. It also has a nice dividend that pays while we wait. So on the small cap front, I like a company called Yangera. YGR, we also own it. So they're also in the Cardium space, West Central Alberta. They're about 2,900 barrel per day producer, and they just released some results this morning. A bit light on the production numbers, but we think that was because of facility constraints, and we think moving forward they can look at 3,000 to 3,500 barrels per day. They did a major joint venture with TACA where they're drilling into their lands, so that's a good sign for Yangera that TACA selected Yangera to drill those lands. So those are two companies on the energy space. On the base metal space, there's two companies I like. On the larger caps is a company called First Quantum. They're a large copper producer in not only in Africa but also in Australia and North America. So symbol is FM. These guys are also growing quite aggressively. They bought the Cobre Panama asset from Inmet Minerals, and that's a big asset in Panama. They continue to grow that. They're expanding in Africa, and they also bought the Ravensthorpe nickel project in Australia. So this is a company that is growing by acquisition. It's growing internally. So we like the copper space, and First Quantum is a name to be in the mid to large cap space. On the small cap space, there's a company called Talon Metals. We also own this one. This is a company that recently signed a joint venture agreement with Rio Tinto property in Minnesota. So right in the U.S., this is a project that is close to infrastructure, both power, rail, and port facilities, and they have a $30 million budget to drill up this property. We're looking for an early resource, say early September, and we think this one could be, potentially the next Eagle mine that sort of got sold by Rio to Lundin Mining. So that's the one I like on the small cap space. On the precious metal side, I like a company called Goldcorp. Goldcorp is one of the largest gold producers in the world, producing 2.5 million ounces of gold. They're focused in the Americas, both North and South America, and some of their mines are some of the lowest cost, highest netback mines that are out there. They also have deep pockets with a strong balance sheet of about $2.5 billion in cash. They recently made an acquisition for Osisko, but lost out to Yamana and Agnico Eagle. So this shows the deep pockets they have. They were disciplined enough not to enter into a bad bidding war. So I'm happy with how they're disciplined with those monies. And now with the gold price dropping from 1,900 to the current 1,300 levels, they're able to continue to be profitable at these levels. On the small cap space, like a company called Lakeshore Gold, LSG. So both Goldcorp and Lakeshore I own. Lakeshore is a small gold producer in the Timmins gold camp. They're able to run 3 mines in the Timmins camp, producing approximately 180,000 ounces of gold per year. Gold costs are about under $800 per ounce. So this is a nice, nimble gold producer, also profitable at these gold levels and able to grow production from not only their 3 existing mines, but some of the satellite deposits that are located close to those mines.
Thanks for taking the time for the interview today.
You're welcome. Thank you.
Our parent company, Beaker Corporation, and its affiliates or partners will seek to provide services to companies mentioned on SmallCapPower. So you should consider all the information on SmallCapPower as an advertisement. Beaker Corporation and its related companies or a connected person may own, buy, and sell securities mentioned in our videos from time to time. We recommend that you consult with a trusted financial professional before making any investing decisions. You can see our full disclaimer here.